Well, we've had a chance now to dissect the RBA statement, and the question is will they raise rates again in the August meeting, or will they go on an extended pause going forward? In the video, we look at the data that you need to have on your radar. We look at rates, pricing, and the catalyst that the RBA are looking at very, very closely. I'll see you on the flip side. The afternoon traders, obviously we've had a chance now to fully dissect the RBA statement, have a look at the collective wisdom in the market, how the herd mentality is seeing the RBA's decision across asset classes, and whether the market pricing is suggesting that the RBA are going to be moving going forward. Now, if we have a look at this in its entirety, the pause, they've said, allows them to have a look at the state of the economy, the economic outlook and the risks going forward, and to take in further information. So they've bought themselves some time effectively, but they still have a firm hiking bias coming through. They have watered it down a little bit by saying they need to look at the conditions and how they evolve and how the economy and the inflation evolves going forward. But generally speaking, they've got a strong bias to raise rates if needed. They have taken themselves somewhat off autopilot and put themselves firmly on data dependency, like other central banks as well. And with that in mind, we are looking very closely at the calendar coming up into the 1st of August RBA meeting to get a sense then if they are going to raise 25 basis points or we get a back-to-back pause coming through. Now, what are we watching? I think really importantly on the calendar, you can look at tier 2 data such as the Westpac Consumer Confidence and NAB Business Confidence numbers that come out on the 11th of July. Philip Lowe will be speaking on the 12th of July. Obviously, people are going to be watching that one very closely. And then we get into other data points with the minutes on the 18th of July, just to get a sense of how close the decision this was. One would imagine it was pretty finely split. The tier 1 data points really come out on the 20th of July, where we get the next employment print. And then on the 26th of July, we get the next Q2 CPI print. Now, of course, the RBA guided to a year-on-year headline clip of 6.3%. Given what we've seen from the monthly inflation reads, one suspects there's some downside risk from that, and that core inflation numbers are going to drift lower as well. And that's something that really could determine whether we get a rate hike at the next meeting. Now, having a look at rates pricing at this stand in the wash-up of the RBA meeting, we can go to the 1st of August and see that's priced at 4.21. So if we take that away from the effective rate, you can see there's about 14 basis points of tights being priced in there. So it's about 56% chance of a rate hike at the moment. So obviously that data that we're getting in, specifically the employment number and specifically that CPI number, will determine whether we get a rate hike there. One suspects the large probability is we do get a rate hike at that one coming forward. Now, if you go into the future months, you can see that the step up to September is about 8 basis points. Into October, we've got another 6 basis points. So cumulatively, by the 3rd of October, we can see about 29 basis points of tights being priced in there. Go to peak pricing for December, which I think is a point of conjecture at the moment. You can see 39 basis points of tights being fully priced in. So the market's saying we've got one more rate hike coming through, and then there's a sort of a 50-50 chance where we get another one coming by the end of the year. So they're a bit unsure in that situation. My own view is we'll probably only get one more, and then we're done. On the 4th of August, we do get the statement of monetary policy, and we expect then once they do raise rates, or if they do raise rates in the August meeting, to back that up with decent upgrades to inflation and employment numbers coming through there as well. The question you've got to ask yourself in this situation then, is the RBA just buying themselves time, or has the reaction function changed? I suspect at the moment it's just buying themselves time just to make that assessment coming through. Now, in terms of the Aussie dollar, we are still seeing some correlation with 5-year rate differentials playing through, but certainly for against the greenback, you've still got a large element of trading it against the dollar CNH. That's a large influence. How Hang Seng's trading, and of course iron ore and other factors as well. On a real basis, if you want to have a look at what's happening in rates, you can have a look at the 3-year government bond. Aussie bulls will want to see that breaking out of 4%. We've seen that consolidating there as well. I want to see Aussie real rates on 10s moving a little bit higher. Again, you can see that consolidation playing through. If Aussie real rates were to move up a little bit, then that could put a bit of a bid back into the Aussie dollar. Probably the best way to trade this at the moment, we've seen the cleanest expression as we always do, is against the Kiwi dollar, and you can see at the moment that breaking down to the downside. So a big couple of weeks ahead really for the market, and as we go into sort of late July, we're going to be watching those employment numbers and the CPI number. That could determine whether the RBA raise rates by another 25 basis points, or we're going to get back-to-back pauses coming through. So a big month of July ahead for the RBA here.